Self-employed borrowers are just not in the know about how easy it really is for them to buy a home. There are a ton of options available, with one of the most popular relying on just a profit and loss statement from your accountant. Where there's a will, there's definitely a way, but it's so important that you use the right mortgage product, or you're gonna find yourself getting denied, or worse yet, losing out on the house of your dreams. I'm Andrew Russell, a mortgage strategist that specializes in self-employed clients who are typically getting denied by using old, antiquated guidelines, offering all the new, cool, amazing, bougie mortgage products hot off the press. Let me tell you about Sarah. Sarah's a very well-known photographer. That's the person you call on Christmas or Easter or Mother's Day. Father's Day is what they've kind of grown into. Has an amazing studio and does amazing pictures. Waitlist for Christmas. Once Easter's over, it's pretty wild. But Sarah didn't realize that I did mortgage, although I was using her for photography for years. She first tried to purchase a house with a big bank, showed her tax returns. There was not that much of a net profit, didn't qualify. Lucky for Sarah, or at least she thought, her real estate agent that she was working with referred her to a mortgage broker who really didn't specialize in these self-employed programs like your boy, and just try to get her into a bank statement program. Now, Sarah's income and the revenue, if you think about it, March, April, May was super high, a little bit of June, and of course, November, December for Christmas. The other months, there wasn't really any revenue coming in whatsoever. So in a bank statement program, that's going to be looked at as revenue volatility and maybe disqualified because it's not a consistent amount over 12 months. So lucky enough, she was referred to me, and I said, hey, there's more options for self-employed clients than just bank statement programs. So we did a P&L program. The P&L program, I reached out to her accountant, and he did a revenue over the last 12 months, the expenses, which weren't all that many, and the profit. At least in the last 12 months, the expenses weren't all that high. I guess there's certain times of the year that they were. So what happens in a profit and loss program? We don't look at bank statements. So we just look at that revenue number. We don't see the volatility. And if you added it all together, which we did on the P&L, she was making a ton of revenue. So she actually qualified off that net profit number, which was the revenue minus expense, that net profit over 12 months. That's what we used. The underwriter went off that, and she actually qualified. But I can hear you saying now, hey, Andrew, you're probably asking that CPA to do something that's, malicious or not accurate. It's actually not the case. Not every business has expenses over a 12-month run. Sometimes these businesses have certain periods that have the higher expenses. So over the last 12 months, the expenses weren't all that high as of yet. Based on the revenue over the 12 months and the expenses, Sarah showed a ton of money. It was like over $400,000 net profit, which is more than enough to buy a house. Or I can hear also saying, hey, Andrew, I'm sure the rate is so much higher. It's actually not. On the bank statement program, say the market rate was 6.75%. The rate on the P&L program was only 0.125 or an eighth higher. So it's pretty much the same. And again, it's always, you get what you pay for. So if you don't want that eighth higher, you're just not gonna be able to buy a house. So it's a blessing to me, and it certainly was to Sarah, to be able to buy with just an eighth higher in rate. Or, hey, Andrew, I'm sure the banks that offer these, if the big banks don't, I'm sure it's an antiquated process. It's super difficult, and it takes several months to qualify and close. It's actually not the case whatsoever. The process is streamlined and it's quick. If you're in contract, you're trying to do a refinance, within 24 hours, you'll get your application. Within a handful of days, you'll have your initial approval from the underwriter. All within that time, we're going to order the appraisal. Obviously, whether you're purchasing and get a title report or the mortgage broker company orders a title report on a refinance, all within that first initial application date, within a week and a half, your appraisal and title and all that good stuff should come in. So you could still, with these mortgages, get a clear to close in 2-3 weeks. You can still close in 2-4 weeks if you want. So it's not a slow process, especially when the company has it down to a science. All right, guys, let's take a look at why did the bank statement program fail? How could it ever fail? It's all we ever talk about these days, right? Why did it fail? And the profit and loss program, why it worked, why it makes sense, and what is it exactly? Just a high-level overview of the product itself. All right, so if you remember, let's say green will be for profit and loss, red will be for the no bueno bank statement. So, we had somebody who was a high-end photographer for Christmas, Easter, Father's Day, Mother's Day pictures. So if you think of the year, you have January, February, March, April. Let's go all the way down. All right, so if you think of the year, when you think of the pictures, right, these 3 months, there was a lot of activity, a little bit over here, and then over here, pretty much these 3 months. So what they did was they just booked a lot of clients. I think it was like $200 each time. It's a lot of money, but this is where most of the activity happens. So I think it was something like 50,000 in deposits, let's say, for these months. It kind of veered off a little in June. Let's say it was around 30. Then it was nothing over here. Of course, up here there was nothing. And then right here for Christmas, they were super busy. My understanding was about 80, and then 60 because, by December, pretty much everyone was already booked and they were running out of time. So if you add it all together, you have 180,000 in deposits up here, and you have about 220 down here, which is pretty solid. But then you have nothing over here. So again, if you add that all together, it's about 400,000 for the year in revenue. Now this was a business that didn't have a ton of expenses. It was a two-person show. It was obviously the owner and someone was there to help her. But if you look at the bank statement program, right? If we looked at these last 12 months of bank statements, the fact that right here showed zero, right here showed zero. This was actually super concerning to an underwriter because how do you go from making all this money to nothing? So they don't really, they're never going to fully understand the dynamics, and they're going to feel like there's a lot of volatility. So they're going to disqualify them completely. So, that 400,000 over here, if they would have used it, let's say it's about $34,000 a month. And then from there, as a 100% owner, right away we can give them credit for $17,000 a month of income, a 50% expense factor. So that $17,000 would have warranted, quite a bit of a mortgage payment, assuming no other debts and a decent credit score, up to about $8,000. That's an 8, folks, for a mortgage payment. You don't want to go to around 40-ish, a little more than 40% of what you qualify for the mortgage payment. But again, this was a big fat no because of the volatility in how the business actually transacted and the months. So, unfortunately, on the left side, this was the bank statement program and she didn't qualify. Good news, here comes the profit and loss program. So if you think of a profit and loss, right, P&L. So you think of revenue, you think of expenses, and you think of profit. So you have revenue minus your expenses equals your profit. So if you look over the last 12 months, the revenue was $400,000. Right, we had the 100 plus the 80, it's 180, 816, 220 plus 180 is 400,000. Now, just remember, on the profit and loss program, the underwriting team, they're not going to see this stuff. So they're not going to see the volatility, the nature of the business. We're going to get a CPA letter. Now, a CPA letter, of course, is going to say the nature of the business. The CPA is going to say, hey, my client is high-end photography, the corporation's in good standing, and I've been doing their taxes for X many years. That's how we verify the existence of the business. And then we're going to get a profit and loss, of course, in the CPA letterhead, which is exactly what we're doing right now. So that $400,000 in revenue, from there's expenses. Now, what are typical expenses? Say in the location, there's rent. So say rent costs them $48,000 for the year. Say there's an employee. Cost them, this is very rough from an expense perspective. It's on my business, folks. $60,000 for the year. Say there's equipment, right? Equipment costs them $25,000 for the year. I mean, you get it. So that equals already 130 some odd thousand. So say there's a little bit more, and we have about, let's say, 200,000 in expenses, right? So from there, the revenue, which is 400, minus the 200,000 in expenses, off this profit and loss, would give us a $200,000 number for profit. So that $200,000 number for profit, that will then correlate to what we can use to qualify them. So I believe in this case, they were looking at an $800,000 house. So let's put the example of the mortgage before we finish up right down below. And we love this here. So you have a $800,000 house for a sale price. 20% down is $160,000. The mortgage is going to be $640,000. So that's for the mortgage, right? So if we assume a rate of 7%, if we assume a 7.5% APR, so you figure it's going to be somewhere just roughly, let's say $4,500, just for rough sake, right? A $4,500 a month mortgage payment. plus taxes and insurance on an $800,000 house in good old Long Island, New York. You figure that's going to be somewhere around $15,000 for taxes for the year, and you figure about $2,400 for insurance, HOI. Right, so that's $1,250 plus $200, so it's $1,450 more. So you figure all in, that's about $5,950. So this $200,000, if you divide that by 12, which is what it is per month, it's give or take around $16,000 a month for income. Assuming a great credit score, and this person specifically had in the 700s, for these P&L programs, 20% down, you're going to want to kind of a 680, a 700 or above. You know, the benefit of these programs, people say, oh, Andrew, is the crash going to happen again? You're giving people mortgages without checking their income, really. You know, it's a profit and loss. You're not looking at their tax returns. They do require you to have decent credit. What is decent? 660, 680, 700 and above. And the profile has to be good as well. So based on a 20% down number, this is exactly what your payment was going to be in this example. So of that $16,000 a month of usable income, you figure up to a little less than half, which is $8,000. So to be safe, let's say 40%. So that's going to be like $6,500 or less is the ideal sweet spot mortgage for the best pricing, which is 40% of that income number they're getting credit for off the profit and loss. So as you can see, $5,950 is right under that $6,500 number, so they would qualify. So this goes to show you on the profit and loss program why it's so good. You know, just to go over it, you have the bank statement program over here. They make a ton of revenue, but there's a lot of volatility, so they just straight up will get discredited and get no credit for any of the income. So then we roll out our good profit and loss program. You know, the profit and loss program specifically, it's going to show you what the revenue is over the 12 months. It's not going to show you what happens each month. It's just, hey, over the last 12 months, the business made $400,000. From there, it'll list out the expenses, a little more granular. Imagine you have a CSV or an Excel file that shows, you know, which then turns into a document. So this is kind of all in rows. Say that all in the expenses are $200,000. That would leave $200,000 as profit. That's exactly what we use to determine the income. Now, income for mortgage is monthly, so we divide that by 12. It's about $16,000 a month. That's $16,000 a month, assuming good credit and good credit profile, as we said. Up to around half of that for all the debt, $8,000. Ideally, 40-ish% sweet spot for the mortgage, $6,500 on an $800,000 sale price. 20% down, which is a real good number for these type of mortgage programs. 160 leaves you a 640 mortgage, a 640 mortgage with a 7% rate and about a 7.5% APR. This is going to translate with the mortgage, taxes and insurance, all into about $5,950. That $5,950 is less than $6,500. Of course, all in under $8,000, which is half of that income. So as you can see, this was the perfect scenario for this photographer, for this entrepreneur, for this self-employed client, without a doubt. Now, guys, check it out. Go into my description. I have a self-employed cheat sheet. This is a lot of, to me, this all makes sense. To you, it might not make any sense. So that's why I made it a super simple self-employed cheat sheet. So make sure you go in our description, click the link, and we'll send it over to you for free. It's a non-negotiable necessity if you're a business owner, entrepreneur, self-employed, and you're in a different space. So all these numbers and mortgage stuff doesn't really make sense. We have a super easy cheat sheet. Make sure you hop in the description, click the link, and get it for yourself. It's free. So now that you know about the P&L program and the hack to qualify if your income's a little bit all over the place, make sure you check out our next video. This is going to be for self-employed entrepreneurs, for freelancers, for 1099 clients. It's going to show you the full gamut of the non-QM product suite, what it takes to qualify, because maybe the profit and loss isn't needed. Maybe you can do the bank statement program or a 1099 program where pricing is a little bit better, but it's still non-traditional lending. So make sure, guys, you check out our next video. We're going to go over it all.